You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Yelena Shulyatyeva. I'm a senior U.S. economist here at the Conference Board and a guest host of today's show. Joining me today is Stephanie Guichard. She's a senior economist of Global Indicators at the Conference Board. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our outlook for the U.S. economy. So, Stephanie, what were the biggest takeaways from the March Consumer Confidence Survey?
Hi, we had a relatively weak reading in March, and our confidence index declined by 7.2 points to 92.9, which is the lowest reading since August 2021. This is the fourth consecutive decline, and now the index is below that range in which it had been hovering for the past 2 years.
Can you tell me a little bit more? What are the most interesting details of the survey this month?
So this month, we had a very sharp decline in the expectations by consumers, and this is really what has been driving this weak reading. We are at the lowest level in 12 years. It's around 65, well below the 80 threshold that typically signals that a recession is coming. So it was really this expectation component that drove the index down.
But both the present situation and expectations decline, right?
Yes, correct. But the one that is really driving this is the expectation component.
So what drove those expectations to decline?
So we have three components in the expectation measure. So the first one is business conditions, and consumers' expectations for business conditions were down. They were already negative last month, and they are getting a bit more negative. Same thing for expectation about the labor market. They went down again this month, and this is the third or fourth consecutive month of decline. And the last component is the most interesting one, I think, in this reading this month. So it's the income. We're asking consumers about where they see their income going in the next few months. And it's still positive. However, it's getting close to neutral. And this is out of the three components, this is the one that is the most personal. So that's the one. The other ones is, what do you think about business conditions in your area? What do you think about the labor market? They're quite general about the economy. But this one is, where do you think your income is going? And the fact that it was quite positive up to February, and in March, it came close to neutral. It means that consumers are not getting worried about the economy in general, but they start to think that this is going to hit them more personally.
Okay. We had some market volatility during that period of time, which, by the way, what was the cutoff day for the survey?
It was the 19th of February.
Right, of March. Yeah.
March, sorry.
Yeah, during that period of time, we saw some market volatility. Do you think that impacted the readings?
So it may have impacted the reading, although we know that typically it's the highest income which are the most sensitive to the stock market. And we saw the decline across the board in terms of income groups. We also saw the decline across the board for age groups, except for the younger ones, where we saw a slight increase in confidence. But typically, you would think that the stock market is affecting the most people over 55 because they are most likely to be on retirement and they are watching their 401k. So that could have played in that direction. What's interesting about the stock market is since November, consumers have completely changed their views about where the stock market is going. So in November, we were at the highest level of optimism about the stock market since we started to ask the question in 1987. And now we are back into slightly, I would say, negative sentiment about the stock market. So we have more people thinking that the stock market is going to decline than thinking that the stock market is going to increase. And if you think about it, the share of consumers thinking that the stock market is going to increase is 20 points lower than at the peak in November. And the share of consumers thinking that the stock market is going to decline is 20 points higher than at the peak in November. It's really a shift in views about the stock market. We know that it typically follows what's happening in real time in the stock market. So most likely people get concerned. If the stock markets improve next month, this may go away, but it's also closely linked to their view about economic conditions going forward. We need to keep an eye on that.
Interesting. I also noticed that if you look at consumers by age group, we saw a significant decline among those 55 and older, right?
Yes.
So those also may be affected by this decline in stock market expectations because they are watching their 401ks very closely. Anyway, let's talk about inflation expectations for a second. So we saw another increase in inflation expectations in our survey, which seems to corroborate the signal from other sources. So what do you think about that?
This is something that we saw for the past few months. Most of 2024 inflation expectations were declining in line with the deceleration of inflation. Then you had the pause towards the end of last year. Prices started to become more. Inflation was flatter. It was not decelerating as much as people were hoping. And as a result, I think early this year, we started to see like inflation expectation increasing again. And it's also because people are looking at what they buy when they go to the stores, and the price of eggs has increased so much and they feel it. So when you look at the BLS data, we had some huge increase in the price of eggs in both January and February. And overall, it doesn't seem to have stopped in March. This is all linked to the bird flu, but people are feeling it. And this is also affecting the inflation expectations. Last and very important, tariffs. We have these writing responses. So we're asking consumers, what is driving your view of the economy this month? And these are words, responses. And we analyze all these responses, and we saw since the beginning of the year an increase in references to tariffs. And this is clearly feeding into consumers' expectations about inflation.
Okay, and probably all the news stories that we hear about tariffs are also feeding into that story about tariffs and affecting what consumers are writing. Any other interesting write-ins that we should be aware of?
In terms of writing, inflation is still, of course, very important on consumers' mind, but they're also talking a lot about the current administration, and both in positive and negative terms, but they really pay attention to what's happening in Washington. And last, something that we noticed especially this month, is an increase in references to uncertainties. And maybe again, this is based on what you read in the news, that economic policy uncertainty has never been so high, but it's starting to feed into consumers' views about the economy. So that's also something very important, and that this is not something we saw recently. This is really new, the writing responses this month.
It's very interesting. Any positive tilt to the survey? Any positive news?
So we had a few positive news. So first one is, if you look back to our index, consumers' views about the labor market, the current situation on the labor market, improved slightly. So it means that they believe the labor market is still strong right now. So that's first piece of good news. The other important piece of good news is you need to, when we look at spending plans, so although on the negative side, we saw some slight decline in intentions to buy a car or to buy a home, we saw some increase in plans to buy big ticket items, whether it's appliances or electronics. So that was quite interesting. So it may be because people are thinking that the tariffs are coming and they want to buy now rather than in 6 months. It may be also that people are looking for just to buy things that will make them happy. They are a bit gloomy about the future, and they are just thinking, let's get some comfort by going to the store.
Like a golden ring or something like that? Is that what you're referring to?
We don't ask about golden ring, but this just go out and spend while you still can, potentially. When you look at services, so as intentions to spend more on services are not really changed this month, but when you look at the priority in terms of spending, so consumers are still planning to go out to restaurants. And we saw some increase in intentions to travel and also vacation plans. It's slightly up. It's still on not so high, but we saw some pickup in plans to go on vacation and so plans to travel. So maybe that's the good news. People are worried about the future, but they are still planning to have some fun.
Well, yeah, totally. A nice vacation on the beach or at a ski resort would certainly bring some comfort to the consumer. Okay, we are going to take a short break and we'll be right back with more on our conversation about the latest consumer confidence result and the economy overall.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspective. I'm Stephanie Guichard, Senior Economist of Global Indicators at the Conference Board. I'm joined today by Yelena, Senior Economist at the Conference Board, to discuss consumer confidence survey results. First, we talked about the survey results, but now we need to turn the table. And I'm really curious to hear from Yelena what she thinks about the implication of this latest reading on US outlook.
So I think, thank you, Stephanie. I think the latest results really corroborate our views on the US economy. So we recently downgraded our projections for the economy overall. We currently expect the economy to grow at roughly 2%, down from 2.3% we previously expected. And that also means that forecast implies the economy would grow at only 1.5% fourth quarter over fourth quarter if our forecast proves to be the right one. That is a significant slowdown, and one of the key reasons for such a slowdown in our forecast is consumer spending. So we have seen a significant slowdown from the third and the fourth quarter of last year and going into the new year in terms of consumer spending. So look, for example, at retail sales. Retail sales declined significantly in January, but did not recover that much in the following months. We'll have to see what happens in March, of course, but overall, I think the pace of consumer expenditures is slowing down. So in that sense, the recent survey really confirms our expectations for this slowdown to transpire as the year progresses.
But our expectation index, as I mentioned earlier, is the lowest since 2013. It's kind of one decade low. So do you think that this is adding risk to your forecast? So you explained that we are expecting consumer spending to slow, but would such a low reading require that we revise consumer spending further down, or at least does it fit into the risk section of our forecast?
So I think you made a really good point in the beginning of the program, is that the expectations component decline was significantly driven by expectations for future income. So I think this is very significant and actually very concerning as a result of this survey, because if you think that your income will shrink, or if it doesn't grow as fast as you are used to, you will probably pull back on your spending, at least for the time being, until uncertainty clears. And this is a very significant word as well. We have heard quite a lot from the news sources over the recent weeks about rising uncertainty. And we follow this uncertainty phenomena very closely here at the Conference Board. Our research shows that it may weigh on growth quite significantly if it persists. So that's a very key variable for our projections going forward. So I think overall, we are not expecting a recession. We're not expecting a downturn. I think consumers still have enough power and enough cash in their wallets as long as the labor market holds. But I think the results, the recent results, and the recent details of the March Consumer Confidence Survey certainly point to a slowdown in consumer activity and growth overall.
Okay, can we talk a bit about the inflation expectations? Once again, inflation expectations by consumer are up, and you mentioned this is confirming other surveys we've seen. So how is it affecting your view of what the Fed is going to do in the next few months, and also how is it affecting our forecast?
Yeah, it's very interesting. Chair Powell mentioned, and he actually talked quite a lot about inflation expectations during the latest press conference following the March FOMC meeting. He said that yes, they have seen a pickup in shorter term inflation expectations from the consumer surveys. But at the same time, market expectations, market inflation expectations are still holding relatively steady. So in addition, he thinks that longer term inflation expectations, things like 5 years forward and beyond, are still pretty stable. So it's a mix, but it's a concerning mix because, again, if this situation persists, that may start affecting longer term inflation expectations. And this is really key to the Fed policy because what we are expecting to see this year is a relatively tricky situation for the Fed where they face this stagflationary dilemma as inflation rises and growth slows down partially because of the impact from tariffs and also because of the recent impact of uncertainty on growth. So I would say that as long as inflation expectations remain relatively anchored, that is not going to be like a critical concern for the Fed. And in this case, the Fed's next move is still going to be a rate cut. And this is what we project for 2025 towards the end of the year. But if we see a situation in which inflation expectations start to be out of hand, like particularly towards the longer end of the horizon, this is going to be a very difficult situation for the Fed, which potentially could cause a recession if the Fed decides to really put the brakes and attack inflation so that that could cause a much more significant slowdown in economic growth.
But this is not our main scenario so far. So when is the next move you mentioned is a cut, and when do you see it coming?
Our projection is for 3 rate cuts this year. We have held this view for quite a long time now. The risks here are for that to be pushed back a little bit, just simply because of all this uncertainty that we continue to talk about. So the Fed really needs to make sure that the next move is the right move. So that by itself could push them to postpone the first rate cut a little bit further. But I think regardless, a slowdown that we are expecting in the economy and some deterioration in the labor market because of that, not a significant deterioration, but to prevent one from happening, that will probably end up having the Fed to cut rates.
Okay, great. So let's go back a bit to the consumer survey, and we are not forecasting our own index, obviously, but so I'm wondering if there is anything happening in the economy or expected to happen in the economy in the next couple of months that may affect the index. And so what do we need to watch first to see where consumers are going to go, what they're going to be thinking in the next few months? What are the economic indicators we should be watching?
Well, as far as the survey goes, definitely I would watch all the labor market indicators. So you mentioned that didn't move much this month. If a continues to decline. And by the way, the labor differential is actually now at the level that is a bit lower than we saw before the pandemic. So in this situation, any move down, further down, would be quite a concern because the unemployment rate is low. But if it starts rising, and that labor differential index is very much correlated with the unemployment rate, so that would be something that I would watch very closely because, again, consumer spending depends quite a lot on labor income at this point. And labor income is something that will drive consumer spending going forward. So that's one thing. Another thing that has been driving consumer spending, which is the key engine of economic growth in the US, is the wealth effect. What was really worrying, and let's get back to that in this survey, is stock market expectations. So if that deterioration continues, that could start affecting more wealthy consumers. And in that case, we may see an even more significant slowdown in consumer spending. So these are the two key things that I would be watching in the months ahead.
Okay, great.
Thank you, Stephanie.
Yeah, thank you, Yelena, and thank you all for listening to C-Suite Perspective. I'm Stephanie Guichard, and this has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.